So let's pick up with financial risk, as something that you have to be aware of. And this basically is associated with the debt that a company carries, okay? So when you're highly leveraged, we talked about leverage and association with loans back in Chapter 7, mortgages in Chapter 8. Now we'll talk about businesses carrying a lot of debt on their balance sheets, okay? And that the fact that if you're going to invest in a company that's carrying a lot of debt, it's a riskier investment than a company that doesn't have debt. Why? Because debt, as we said, is like a ball and chain. You've got to make that payment. You're legally obligated to make that payment, okay? So certainly if you've got problems, temporary problems or setbacks so that your business's income decreases, let's say, for a period of time, well, you still got to make those debt payments, right? So if you have an investment in a company that has to make the debt payments, they can be less able to weather a temporary setback or a storm than investing in a company that has very limited debt that could probably weather the storm better. So you got to be very aware when you're making investments, especially in common stocks, that the company that you're investing in has limited debt. Of course, companies usually carry some sort of debt, but you compare your company to other companies within the industry to make sure that it doesn't have exorbitant debt. Right, because a lot of debt means that they have to make those payments to outsiders before they can make any payments of dividends or interest to you, or of course impedes the growth of the company if you're buying the stock for growth. So that's one thing you have to watch out for. Liquidity risk is another risk that's associated with certain types of investments that aren't so easy to sell if you need to sell at a moment's notice. Okay. Certainly, if you have stock in a company like an Apple or an Alphabet or Facebook or something like that, common stock, they're very highly liquid. Okay. What does it take to sell the stock? Basically, you get on your computer, you get on the on your mobile phone or the telephone, and you can sell it in an instant because millions and millions and millions of shares are getting traded throughout each and every trading day. So liquidity risk is very low, but other risks associated with other types of investments, most notably, obviously, selling a house, real estate, is going to be very high because you just can't wake up one morning and say, oh, you know what, I'm going to sell my house by 2 o'clock this afternoon. Not going to happen, right? It's going to take a long time. You're going to have to find the right buyer, the right price. You're going to have to interpose a lot of legal qualifications before you can make the sale of the real estate, like we saw back in Chapter 8. Same thing goes for investment real estate as it would be for your own primary residence. So and there are certain stocks, believe me, that are very illiquid. Okay, so basically if you have a stock that's possibly a company nobody's heard of, you're looking to make a speculative venture on something based on the fact that they might make a new discovery or they might get a patent for a certain device to cure cancer or something like that, that company probably has got very few shares outstanding, and it would be very hard to trade on a moment's notice. So even common stocks can have a liquidity risk associated with it. Market risk, certainly there are times when emotions take over, fear and greed take over, and when fear grips the markets, a lot of times everything is going to be going down. There's nothing you can do about it. Of course, 2008 was probably the most recent example of a situation where every market around the world, with the exception of the U.S. Treasury market, went down. I'm talking about real estate. I'm talking about stocks. I'm talking about corporate bonds. I'm talking about commodities, gold, you name it, it went down in 2008. Obviously, for those people who needed the money quickly, that was a real problem. But again, for those people who are looking for an opportunity to buy low so they can sell high, 2008 was a tremendous opportunity as the markets have all tripled since the low point of 2008, early 2009. Okay, so when you look at the stop and think, Warren Buffett says most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. He's talking about the situations sometimes when market risk gets to the point where it's irrational and everybody is selling because all investments are going to zero tomorrow. All of a sudden Apple is no good, and all those great companies, the greatest companies around the world, all of a sudden they're going to go to zero because people are gripped in fear. That's the time, of course, to scoop up bargain prices on these investments. So there's market risk associated, again, with emotions. that generally prove out to be quite temporary as the market inexorably grinds its way higher. Political and regulatory risk. Okay, so here are risks outside, obviously we see what's going on currently here in 2019. President Trump levying tariffs on all over the world, from China to Mexico, right? And every time that seems to happen, there is a risk now that there'll be a retaliation by those countries, and so that goods sold by American companies overseas become more expensive. What happens when goods become more expensive? Your sales go down. So if you're investing in a company who's selling overseas and their sales go down, guess what's got to your investment? You got it, down, right? So political and regulatory risk, the fact that tax laws may change, there's always something that has to be considered, especially if you're going to be investing in countries. Remember, you can invest in other countries. If you invest in countries that are politically unstable, you may always have that risk, and you have to take that into account when making your investment decision. Exchange rate risk, okay? Different countries, as you're well aware, have different currencies, okay? Perhaps you're not aware that these currencies trade against each other. They go up and down in value in opposition to each other, okay? So there are times where the dollar is particularly strong as against the euro or against the yen, other types of currencies. There are times when the dollar weakens, okay? So how does that affect your investment, you might ask? Well, let's say you're a company that's involved in selling a lot of its product overseas, right? So basically, you're going to have to sell in the currency of the country you're selling in. Then you have to take that currency, convert it back to dollars so you can bring it home back to the United States, okay? As currencies go up and down, obviously, even though you might make a sale at a certain price in yen or a certain price in euros, okay, by the time you exchange the currency back to dollars, okay, that could be at a very different price than you originally thought you had sold it for. So sometimes it works to your advantage, and sometimes it works to your disadvantage, okay? So basically, I think we have a problem. We have a question in the assignment on that will show you basically what an exchange rate risk is in the way of numbers. So you can take a look at that as well. And then lastly, call risk. Call risk is associated pretty much with the bond market, lending investments, bonds, basically, and the fact that just like you, remember back in chapter 8, I always told you that you're going to get a mortgage, make sure there's no prepayment penalty on that loan so that you can retire the loan early if you want to. Same thing when you're now the lender and the company or a government's the borrower, and you're talking about a bond. So a bond is the inverse of a mortgage, right? In a mortgage, you're the borrower, the bank's the lender. In a bond, you're the lender, and the company or the government is the borrower, okay? So just like you had the ability to retire your debt early, if you felt that the interest rate was too high, in a bond, the government or the company can exercise their right to retire the bond early if they feel the interest rate is too high. So that's a risk that an investment that you might have that is giving you a great interest rate could be taken away from you. Of course, they have to pay off the debt, but that great interest rate you thought you had might disappear again due to call risk. So those are the risks commonly associated with investing that you have to deal with in order to get an outsized reward. If a client of mine would say to me, I'm not prepared to take any risk whatsoever, what do I tell them? Of course, put your money in an FDIC insured account. That's the most, or a U.S. Treasury, a bond or a U.S. Treasury bill. Those are the riskless investments out there. But of course, the potential for reward is going to be very, very limited in those investments because the risk is so low. So at your age, you've got to be prepared to take risk, but you should be taking intelligent risk, right? Not speculating, but investing, as we talked about in our last class. Okay. The next section talks a lot about sunglasses and umbrellas. Okay, basically a resort, basically offering those types of products for sale. Okay, and what they're trying to get to in a way that you might relate to is the fact that when you go to the resort, you don't know if you can hit a sunny week or a rainy week, right? And so if all it had were sunglasses and a rain for the week, they'd have zero sales, right? So the fact of the matter is, you've got to sort of not put all your eggs in one basket when you're investing, okay? You've got to make sure that you have some sort of what they call diversification, okay? And diversification simply means that you have different types of investments that outperform in different types of economic climates, because nobody can predict the future, okay? So you want to have certain investments that do well and have aren't exposed to interest rate risk, while other investments, like we talked about with bonds, are highly leveraged to interest rate risk. Okay, you have some investments that might do well in inflationary times. Commodities, real assets do well in inflationary times, while other assets do better when there's not that much inflation and disinflation. Sort of like bonds, stocks and bonds, financial assets do better in that environment. So you've got all kinds of different situations, you know, even within one sort of an investment, you have to diversify, okay? Say you like stocks, right? And you want to buy common stocks. You can't have all your common stocks within the same industry, because if that industry suffers a setback for some reason, then of course, once again, you got all your eggs in that one basket, okay? One example I'll give you, energy prices, okay? If energy prices start to skyrocket, okay, that's great news if you happen to be an oil company who's got inventory of oil at much cheaper price. So now we're going to look at the regulations of the security markets from a little bit of a legal perspective. I'm not going to get too crazy about it. We'll talk much more about it when you join me in Business Law 2, and we talk about securities laws. But for now, I want to talk about a couple of concepts. First, churning has nothing to do with butter. But basically has a lot to do with activities that brokers sometimes use on unsuspecting clients, where they frequently buy and sell stocks, not for the profit of the client, but for the commissions of the broker. Okay. Now, obviously, as markets go up and clients' accounts go up, there's a much complaining about churning. In fact, customers think that their brokers are a genius. Look how they can buy and sell these stocks and they keep going up. When in reality, they all would have went up anyway with a lot less commissions, okay? But when the market starts to go down, ooh, that's when people start to take a much closer look at what's causing a decrease in their balances. And if they see a lot of trades are taking place that don't make sense, that's when brokers sometimes get their hands caught in the cookie jar on a charge of churning, excessive trading of customers' account to exacerbate brokerage fees and commissions. Probably the bigger issue when it comes to illegal transactions is what they call insider trading. Now, wait a minute. Now, let's get one thing straight. Okay, insiders are allowed to trade their stocks, okay? What do we mean by insiders? We mean the people who run the company. We mean the board of directors, right? We mean the officers, right? We mean the CEO and the CFO and the COO and, in some agricultural companies, the EIEIO, those are the officers, okay, that basically, you might want them to own stock in the companies they run, right? Because if they own the stock and you own the stock, they've got a vested interest in making sure the stock price keeps going up, right? They want to maximize shareholder value. Why? Because they own it. They own company. In fact, there are websites such as Insider Cow, Moo, to keep up on the agricultural thing. InsiderCow.com. It's a legitimate website that tracks the purchases and the sales of insiders in their companies. Now, how do they have this information, you might ask? Because every time an insider buys or sells shares, they must report the transaction to the Securities and Exchange Commission, which must make that information publicly available, okay? So now, you figure, hey, listen, who knows more about whether a company is undervalued than the insiders, right? If they're buying shares in their company, why, I should do that too. Now, of course, sometimes insiders drink the Kool-Aid. They think the company's better than it is, and they're not always right. But a lot of people do swear by this technique of following the insiders. Buying when they buy, selling when they sell. in order to maximize profits. So that's kind of interesting. That's purely legal. Okay? When does it become illegal? Right? Sick bird, illegal. Right? When does that happen?